Hello again. This is Josh Kahr with The Real Angle, and today I'm speaking with Eric Doroski at managing partner at Zanzibar Capital. Eric, how are you doing today?
Good. I'm doing quite well. Thanks for having me on today, Josh. I've been looking forward for it for the past couple of weeks since we got this on the calendar.
Excellent. Glad you could join me. No, and I wanted to speak to you because we get a range of people on the call, and it's always good to get people who are in the trenches, so to speak. I try to mix it up, say half people doing deals and half people giving money to people who do deals. So I would put you in the doing deals category. So with that very quick intro, let's talk about what kind of deals are you doing. So you're at Zanzibar Capital. What is Zanzibar Capital? I guess is the best place to start.
Sure. So Zanzibar Capital is a very lean business at this point. It's my business partner, Nitsan, and me with most, if not all, third-party property management, et cetera, services outsourced so we could be the most efficient and be very hands-on with that.
Sure.
We're focused on the greater Boston markets, which we are in. So not just the city of Boston, but surrounding suburbs. We've looked. I like to say, hop in a car from downtown and drive for about an hour. That's probably non-scientifically where our radius is at
Now,
this
are
point.
you a Boston native or like why Boston?
I'm not. I grew up in LA, but I went to Northeastern. I've been here about a decade. My business partner's from here.
Sure.
Really like it here, got settled in here, and now it seems crazy living anywhere else, which is a great problem to have.
Well, that's a testament to Boston. So no, it's a great city. It's good that they kept you. Boston's biggest problems always seem to be brain drain. Great colleges with a horrible track record of actually keeping anyone in the city after graduation.
Yeah, they
So
all seem to head south to New York City, or I guess when I was graduating, I don't know if it's changed since, head west to San Francisco, Silicon Valley, the next latest tech opportunity. But you know, I have to
uh,
say a fair amount of people have stayed in the Boston area, at least from Northeastern. I don't know if that's not quite the same case as other colleges, which is good. I mean, there's a lot of opportunities within, education, biotech, finance, I mean, real estate, as we're showing here in the
yeah,
city.
I'm a bit older than you, and I'll say that's a shift that I've seen over I mean, I'm 49. That's a shift I've seen since I graduated college. Boston's done a better and better job of retaining, but nonetheless, so you're focused on the Boston market, or greater Boston area. Product type wise, mainly multifamily, or what do you?
Multifamily mixed use. We have a couple of projects or properties that have ground floor retail. I would say it's still a multifamily driven thesis in terms of the upside. It just happens by zoning or the fact that it's on a main street that there's a couple of retail openings in it.
Got it. And then right now, I mean, what's your sort of investment to development pipeline? Like, where are you spending your most focus historically? What have you done? That sort of stuff.
Historically, we've done a lot more investing than development, but we've been adding some more development projects into our sourcing pipeline. We're working on a condo project that's 32 units, about 30 million total value in South Boston that is mid pre-sales at this point. And if we say the pipeline today, we're seeing a
Right.
mix of both coming through. As you can imagine, giving the rate environment, it's a lot slower than it was in 2021, but we're still seeing movement. We just have to be a little more discerning than we even typically are.
Yeah, and it seems also, I mean, it's, a lot of things. I mean, well, at least what I'm seeing in my own space is it's not just a lack of debt, it's also a lack of equity. A lot of people have just pulled back in general. I mean, I know I was looking at a transaction recently, and the broker said to me something to the effect of, now, do you have the equity to do this deal? And at first, I was taking it more like he was saying, do you, Josh, have the equity? And it was more him saying, no, everyone I've spoken to, like, I'm asking this question to everybody. Like, it's not a personal affront. It's more just me trying to understand where the hell everybody is. Um, Now, as far as the development deal you're working on, so it's 32 units. What's the mix? Tell me about that deal. I'm interested in hearing about your current project.
So it has below grade parking, ground floor retail, and just moving from top from bottom to top, and then 32
Sure.
residential units above it.
Okay.
With the city's current zoning requirements, we have 5 affordable units in it, 27 market units.
Okay.
And part of what made that deal particularly enticing for us in this environment is that the retail space was being sold back to the initial seller of the property. He's run a
Hmm.
local grocery store in the area for decades. The market itself has been around for, I think, about 100, 110 years or so. So having him come back, it's the best tenant amenity to have. You have a grocery store and a cafe on the ground floor, and it
Sure.
de-risks the retail. We're not in the retail business. If we were, I'm sure we'd have more comfort with that space, but we understand where someone decides to rent or live at the end of the day, not as much of the retail side.
Yeah, retail's its own beast. Now, out of curiosity, so they obviously had to move out when you're building this thing. So they were running their market in a different location, and then they're going to come back or something, or how's that work mechanically?
So currently he's closed at this moment,
Okay.
and it was by intention. At one point, he looked into building the property himself, and he chose not to, given, once again, he's not necessarily in that part of the development business. He doesn't
Sure.
have an LP capital stack like we do that de-risks the deal from saying putting all your eggs in one basket as a small business owner. So he's
Got it.
been closed for about 2 years. We're hoping for him to be back by the end of this year. Maybe if his build out takes a little longer, first couple months of next year.
Got it. Got it. That's interesting. That's interesting. And then when he comes back, I mean, you're building this stuff as condominium product, I imagine. So he's then going to own the ground floor. He's going to do a long-term lease with you. What's that look like?
He's going to own it,
Oh,
which makes it
cool.
even more attractive to us that, once again, not being in
It's
the
just,
retail business, we don't want to have retail condos on our balance sheet, at least at this moment. It would be not our core focus.
yeah, I mean, not to editorialize here, but retail condos are always sort of a strange beast. I always seem to get these emails from brokers about retail condos, and it just doesn't seem to me. I mean, I guess there's someone out there who must love buying them, but it always seemed to be sort of the tail wagging the dog. Like, great, what do I do with a first floor with a gym in it and a 20-story tower? Like, how deep? I imagine that's the kind of strategy. If you specialized in it, you could probably make a lot of money because you'd be the one guy who's like passionate about it. But for the rest of us, I kind of think of it the same way I think of as like cell phone towers. It's not what I do. So
Exactly. If we were in a position where we got a cell phone tower on the property, we would probably sell it to a specialist and just continue on, because we're not in the business of operating, renewing those leases. Maybe down the road we would choose to pivot that way, but we don't have enough data to make informed decisions.
at one point I owned a decent sized apartment building portfolio, and my partner and I discussed, hey, should we buy a bunch of laundry machines and set up a side laundry machine business where we own the machines and blah blah blah. And you run all the math and you're like, yeah, I guess it could be a business, but like, yeah, my time is probably better spent doing something else than
And we've
being the
always,
king of laundry machines.
yeah, during our renovations to our multifamily portfolio, we've moved towards third-party services with a revenue split.
Sure.
And many of the cases, the service we most commonly use has an app to it. I believe there's still a coin way, but if you don't want to pick up, coins at the bank, or you're going through your roll of quarters too quickly, you could either order a card in the mail that you
Right,
tap
right,
and
right,
use it
right,
like
right.
a transit card, or pay from your phone,
Yeah.
which by far is the most attractive way. It's gives you 3 ways to operate the machine versus having to get coins. I mean, it's like the move for parking meters that it would be, you know, you'd lose a lot of revenue if your parking meters didn't have a digital service to them too.
Well, everything's gone cashless. Yeah, no, we are a cashless society. I'm rapidly. That's a whole other conversation. But yeah, I can go weeks without actually using money for something at this point. Now, because you mentioned parking, does this have parking? And if so, is EV charging a thing? Just because that seems to be every other conversation I'm having is, what about EV charging? That seems to be a
So
topic of
we
discussion.
we do have below grade parking in this
Right.
project. Since
You
it's
mentioned that.
condos, they will be deeded spots. We're not providing any spots with EV parking, but we have with EV charging, but there are spots that are EV charging enabled. So they're close to the electric meters, and we could basically we run the pre-wire of the 240 volt wiring to that spot if they're interested in it. But
Got it.
if they choose to do it down the road, it's a relatively simple fix. You're talking 20 feet of conduit through
Sure.
a garage where you're not having to tear down sheetrock or anything of that nature. So it's a pretty easy retrofit.
Yeah, that sounds to me like something like after you've sold out the condos, the condo board, probably 6 months after you sell it, they'll get together and be like, hey, let's have an electrician just do it. It does seem like we're definitely at a tipping point where if it's not you doing it, it's the board shortly after you selling the thing is like, yeah, actually, we need to just do this.
Exactly. And
Um,
our goal here was to make it as easy for possible, whether the board decides to do that in 6 months, whether
yeah,
individual buyers over the next, say, 5 years when they get their first plug-in car decide to do it.
yeah.
From my
You're
position, if I was to get a plug-in car, I would want to have a spot that has the flexibility, even if I don't have one now. Just knowing it's better to have the option than having to be left with a very large electric bill in 5 years when that change happens, or maybe in 3 months,
No,
something
it's
like that.
interesting. Massachusetts, like if you were California, you would have done it already, and if you were Texas, it would be in 5 years. But Massachusetts is somewhere in the middle, so it's a tipping point. Cool. So you're doing pre-sales. Are you looking now? Is the goal as a firm moving more towards development and away from investment? Is that where you think you guys are going to go, or if a 50-unit value add apartment deal ends up in your lap, you're like, yeah, let's run for that too.
I think it's a mix of the both. Still, that we're looking at both. If you ask me what deal would I want to do next, whether it's development or investment, it's we're indifferent. The obvious downside of development is that it's more hands-on, but it's easier to get scale to. And in the
Sure.
Boston area, with a lot of older housing stock, a lot of fragmented ownership, in the sub-institutional space, if we have a database of every building that's 30 plus units, the list is a lot shorter than you would expect it to be from a first look. So if we're looking, especially in the core of Boston, if you're looking at these 30 to 100 unit buildings, there's there's a good amount of them, but it's easier to build in some cases than find some of these larger ones instead of picking up a multi-property portfolio.
Right. So let me spin it around a little bit and ask a question I always like to ask. So I mean, there are obviously a lot of operators in the market, a lot of developers in the market. What do you think you guys like? Where do you think your sweet spot is? What do you think you're bringing to the table that maybe other players aren't? What do you think? What kind of deal works for you guys that other people might turn their nose up at? Like that sort of stuff.
We tend to, I would say, our product type is similar to a lot of other people in the industry, but we take a very data oriented approach. My business partner, Nitsan, is a mechanical engineer by education. I studied math and econ. Both of us have a strong numbers background, strong approach. So, we go through, we want to run the property in the lean Six Sigma way, per se. I know that'll be a common thing said, but it's iterating on the expense side, saying this utility bill is too high. How do we get this down and work on that? How do we, this deferred maintenance item keeps happening. How do we figure out
Right.
the right time to fix it with something that's a longer term fix? And in terms of us versus, let's just say, mid-size, slightly bigger or more, well along shops than us, we'll take even a 15, 20 unit deal very seriously, very hands on with it, with, all elements of charges. I mean, we're running through $150 disposal repair charges saying, should we just replace it, et cetera, with our property manager to give the idea of, how hands on we are. We'll see every
Fair
single
enough.
charge across our
Fair enough.
desk.
No,
And that's the thing with the small scale, which is great to have now.
well, and so here's something I was going to ask because I saw on your website some mention about being data driven, and your website, and I usually mention this at the beginning. It's Zanzibar Capital for anyone listening. So again, that's ZANZIBAR capital.com. Um, I saw the mention on the website about being data driven, and I get that, respect that. My undergrad was in econ. I did an econometrics thesis. I've always been a stats guy, so we're probably similar mindset. Um, do your investors get that? Like, or how do you convey that to your investors? Because like being data driven is great. And don't get me wrong, I think it's the way to go. But when you're talking to investors and explaining to your equity partners, hey, give me your money, basically. How are you conveying that to them?
I think the way our investors see it is that there is generally a quantitative answer to our questions. We're not going to give the big blob of data per se, but if there's a specific question of why do you think this value will to get to here, or why is this number jumping to this number, that it's not a gut feeling of why this is happening that way.
Sure.
We have the gut feelings. We've passed on countless deals because of bad gut feelings with good numbers, but it comes down to good numbers. And to have that confirmation of the answer, I think it gives the investors clarity that we're not making up answers. If you want to look at the sources of our answer per se of why this number is what it is, there's a reason.
No, and I appreciate that. Your comment made on gut versus data is fair. I mean, you don't want to be so data driven that when you have a bad feeling, you ignore the bad feeling. I mean, if it seems like a horrible idea, it might just be a horrible idea. Like,
In this
and that's
situation,
fine.
a bad gut feeling. We'd much rather have a false negative rather than a false positive, where there's deals we passed on. I mean, there's so many deals we passed on that I see someone selling it, or the rents they're getting on it, where the strategy's gone full circle quicker than expected for a much higher price than we thought. And there's always that little feeling, that could have been us. We could have run
Sure,
this deal
sure,
like that.
sure.
But when you have that feeling, I'd rather pass on 100, you know, good deals than end up with 3 or 4 bad deals. I mean, it's
No, I hear you. Look, I'm a big fan of true crime, and in all the true crime stuff, there's always the thing where the woman says something to the effect of, I had this bad feeling about the guy, but I was convinced because of what I saw in paper that I'd stick around a bit, and who knew he was an axe murderer? It's like, look, if you think he's an axe murderer, just run. Like, just don't convince yourself that well, but he has a good job and he said the right
exactly
things.
well put.
Yeah,
And same thing with the
yeah,
financial engineering. That great. Sometimes financial engineering, creative debt structure, seller financing, it sweetens up a deal that maybe you're on the edge about. But if it's not a good deal project wise, there's a problem. It doesn't matter if the seller will give you a sub interest rate and you say, "Oh, I'm saving 100,000 a year based on
right.
this. We're $500,000 off on price." That should be the bonus on
Yeah,
top
yeah,
of it.
yeah, 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 yeah.
Shouldn't be the only way the deal works.
No, and I appreciate what you're saying. I think too often people who are data oriented, if I can put you and me in that kind of bucket for a moment, I think sometimes we get a bad rap, and that people who are gut people kind of look at us and are like, well, but they're just numbers people. It's like, no, we're not saying that it's all about the numbers. We're just saying, as you said, it's like the numbers sweeten the deal, the numbers make it work better, but we're not
There's an
trying to
issue
make bad
with
deals.
latency and comparing options, that there could be a comparable deal that's either under contract or that we hear rumbling about, that it's not a data in our data set yet, but
Right,
it's important to be cognizant.
right, right, right.
Same thing with, if we're valuing a future market development, we're not necessarily only going to look in the half block radius. We're going to say, if we're looking in downtown of this town, what's a similar town? What's a town that's followed the trajectory? And that's not, it's a semi quantitative part, but it's
Yeah,
saying, if we're in this neighborhood of Boston and it's acting like this neighborhood did 10 years ago,
sure.
why don't we look at this just as a hypothetical? It's not going to be our base case, but it's an idea of optimistically where we could head. And,
Art
we've all had,
artists often are part of the gentrification process. If you see little arty boutiques opening, we don't have to count the boutiques. We just have to be aware that that's the way it always has worked and probably will continue to work. So talking about broader economy stuff, like obviously interest rates have gone, I don't want to say crazy, but interest rates have gone up. Banks have pulled back a lot. So what are you looking to do over the next few years? And that I think ties in with also the, what do you think about broader economy? I don't want to say what do you think the economy will be, because your crystal ball is probably as good or as bad as mine too. But like, how are you looking at new opportunities vis-a-vis what's going on in the economy, I guess?
so the way we're thinking about the interest rates now, as you go back to the Buffett quote, only when the tide goes out do you discover who's swimming naked. And
Mhm. Mhm.
that's a case of, there were a lot of deals with low interest rates that worked, including ones we looked at, bid on, et cetera, that in a higher rate environment wouldn't have the same edge to it, wouldn't have the same interest. But we're a strong believer that is going to happen in the reverse. We don't know when rates are going to go down. We don't know how much they're going to go down, but we are relatively confident that this is a higher point of rates in the market cycle, whether that means 3 years, 5 years, 8 years from now, we'll be in a much cheaper point. And what that gives us is the opportunity to look at assets that they're good from the start, but when we have that refinance, it gives a chance to return equity to investors or increase cash flow, or likely a combination of the two. And part of the good part to have low rates locked in, but the downside of it is we have a couple of rates that have 8 to 10 years left on the loan term, since we've gone for fairly long duration loans. And we have a ton of equity left in the buildings. These are prime refi opportunities in a stable rate environment, but
Right.
that equity is locked up. We're not going to get a supplemental. It doesn't make sense in that case. But if we're buying a building that's, say, a 6% interest rate, then if it goes down to 5 at some period of time or into the 4s, you do have that opportunity to refinance. And
Right.
same part on the construction side. If you can build a deal that works at a 6%, 6.5% interest rate, you're going to look much better when rates are at 4.5%, 5%, with both revenue growth, with rent growth, and rate cuts.
Right.
And
Right. Right. Right.
we're not going to be ones to predict it when, but they will get lower at some point.
Sure. And then as long as you have long-term paper and you can survive between point A and point B, when it drops, it's a
Exactly. I mean,
bonus.
we've gotten, it's sometimes been more difficult to find debt when we're looking for 10-year money. We got 12-year money on one deal where we just wanted to have long-term debt locked
Interesting.
in with certainty, and it helps us sleep better at night. Maybe we
I
would have shaved 30, 50 bips off the rate if we went short duration, but then we'd be left with a loan term coming up in 2024 this year, and we wouldn't be too happy.
12 year is an odd number. Was that a bank? That's an odd number for a term.
That one was agency. They
Okay.
offered both 10 and 12 to us, and the spread
Okay.
between the
That's
two
fine.
was extremely small. And we said, so the only difference is a slight difference in prepay. And it was a 4.04 interest rate. We said that's a good rate
Got
by
it.
any logic, any test of time. And
Yeah, no, it's just cheap money.
that was pre-COVID for reference for that
Yeah.
rate. So we go, this is going to be a good rate. Maybe we'll get a little lower, but we're going to be happy with this one in the long run.
Yeah, you don't need to chase. Yeah, when you're chasing basis points, it's a little
Mm-hmm.
ridiculous. No, it's curious. So I guess one other question I want to ask. So your equity sources right now, it's traditionally raising money from LPs. You're working with family offices. What's that look like for you guys?
So mix of LPs, we're always taking minority stake investors, at least to this point, which
Sure.
from our just non-scientifically is generally under 25% of the deal. That way, there's not another party that's driving the deal. We're not opposed to JVs or partnerships like that. We just haven't had the opportunity that it would work for. And these are high net worths, smaller family offices,
Sure.
even fair sized family offices that just understand the lower mid market deal.
Right.
As a big family office, it's likely inefficient to be writing smaller checks into, say, a $3-5 million raise where you're only maybe $1 million slice in it, potentially even smaller than that. That's tough to deploy a lot of capital.
Interesting. Interesting. No, it's always fun to talk about this stuff. I mean, it's we have the network of the a lot of the same family offices are curious because they're all different because they're people. So it's always fascinating to me when I talk to family offices to figure out what rings their particular bell. So I just always like to ask what you're looking at.
But in
So
some ways, it's nice that they all have their own spin to it. It does make it a little tough to scale
yep,
per se, but it's more like investing with a person than an institution where there's looking for X IRR, X deal size, very big specifics. Where if we bring a family office a 46 unit deal and they say we only do 50 plus, they'll be able to work with that. But if you're approaching an institution that does 200 plus units, maybe they
sure,
would pass on 175 just because
because it
it's
doesn't fit in the box. Yeah, it
it
just
doesn't
doesn't fit
fit
in
in
the
the
box.
box. And
Yeah, yeah.
the family offices we work with are able to think outside of the box. It's more of, does this make sense? And
Yeah,
I
and
think
the challenge I've had with institutions is on one hand you have an institution, but you still have a relationship with a human being, and then it's like, okay, you've got a good relationship with Fred who works at Prudential, then Fred leaves Prudential. Who's your guy? Like at the end of the day, it's still about the people you deal with. Whereas family offices tend to just have less turnover because it's a family office.
And in some
Um,
cases, we're working directly with the principal or the family of the office, not necessarily
right.
with, the accounting and that part of the vetting, but
Yeah.
the
You're
the
worse.
30-minute pitch of this is what the deal is. And then, you know, their internal team will probably rattle off a bunch of technical questions, or they will too. But,
Sure.
it's you can tell that there's flexibility. It's more like talking to a highly educated team of people, highly educated in terms of the industry, not education overall.
Yeah.
And in
No, I
some
understand.
ways, they help us find our blind spots and get answers to our blind spots sometime with these questions to have industry professionals poking apart the deals. It's honestly a great thing to have happen.
No, it's all good. So, last question I always like to ask, which is, there are always opportunities in the market. Are there any things in the market going on right now that you think are interesting, but are not for you? Like, we talked about sort of the oddball condo retail stuff, but what do you, or trends that you're seeing that you think are going to be more of a thing down the road? Just a general open-ended question.
So to speak specifically to the Boston area market, we're
Sure.
seeing the trend of a lot of full affordable projects with heavy subsidies and grants backing them.
Okay.
At this point, it's an interesting space. I know people in that space that they're building types of projects that could never pencil as a market project, which is interesting. It's either you know, more often than not, it's a zero parking type project on a tight lot that it really wouldn't work great for a market site. And Boston's got a huge housing shortage. It has to figure out a way to build more of every type of housing, affordable,
Sure.
workforce, entry level luxury, etc. And
Sure.
it's a space, if someone brought it to us and was acting as a partner, we could consider, but on our own, it's a long waiting period and there's a lot of legal and political risk to it beyond what's comfortable. But it's interesting to see that's a common way a lot of projects are being built now. Say
No, and
someone
the
brought a project to us looking for
yeah.
us to fill in the last part of the stack with the grants in place, that's okay. But I can't imagine being on the grant cycle of waiting every quarter, 6 months, et cetera, to say, are we going to get this allocation? Nope.
Mhm.
On to the
Mhm.
next. All right. Fingers crossed it's Q4.
Yeah, that's more managing deadlines to know that, well, the annual allotment has to be in by May 1st, and if you miss the May 1st deadline, dot dot dot, and who's your not-for-profit community partner and all this kind of jazz. No, it's interesting. That's interesting stuff. Many years ago I worked on a project in which Catholic Charities was very involved. And I'm not used to dealing with charity folk because that's not really what I do, but like that's a side of the business. So,
It's
and
great to
people.
see things getting built that way. I mean, it means that these programs are working to some extent, which is always nice to
Sure.
see.
No, it builds housing, but it's not. I'm kind of where you are, which is it was not something that I decided to make my career about, where other people have learned all the nuances and the legalities of how you get all that stuff done. It's more about documents than it is about deals, it seems. But well, fair enough. Well, this has been good. Look, it's always fun to talk to someone doing what you're doing, especially because I imagine that over the next few years the projects get bigger, right? Because if you can build a 30 some odd unit, you can build a 300 some odd unit. Just add a zero to everything, and it's bigger.
That's
So that's the hope, right? Be building huge towers. It's fascinating, and I love your approach, which is why I wanted to talk to you.
appreciate it. And one of the really cool parts about the business is that we're seeing these trends before they start to become trends. And,
Sure,
you know, we'll read, I know office conversions are a hot topic. We, as probably a lot of mid market developers, have been looking if any of the numbers work, walk through a couple of sites, et cetera. And our number per square foot to buy, we get to, and then you see a Wall Street Journal article 8 months later that the underwriting, the numbers, et cetera, look the same, except it's an institutional shop picking up that in New York. And you go, huh, we saw this coming 6 months before anyone in the journal started buzzing about that
well,
at this
well,
site specific.
and not to be the older person in the phone call, but I am. When people talked about office conversions and they were making this all new, I entered the industry in '96 when I got out of college, and I'm like, well, shoot. I remember we had all these conversations in the late '90s. Like, it's literally, I mean, again, the math is somewhat different because costs have changed in 20 plus years, but the conversations about floor plates and core to depth ratios and are the windows operable, like we did all of this in the '90s. It's just now we're doing it again. So, the journal made it out to be like this was some new concept. I'm like, I can rattle off 10 or 20 buildings in New York City right now where we did this.
Which is
We
great.
the
And I
industry.
know from the outside, it just seems easy. Why don't you turn the office into residential? You're asking, this is a really big question. This is not just the same as, renovating a bathroom or a kitchen or adding an extra bedroom to a single family house. You're talking
Right.
about really complicated architecture, structural changes. I mean, some of the
Well,
New York projects, speaking of New York projects, that
sure.
Flatiron project is, I love that building. And that's going to be interesting to see how that one turns out. I know it's going to be a very high end, nice project, but that's going to be a beautiful project. That's
Yeah, I
amazing.
mean, look, there definitely is a demand, and a people will pay a premium to be in a historic old office building because the lobbies are awesome and the ceiling heights are cool and the design is neat, et
And
cetera,
in
et
many
cetera.
cases, they're in neighborhoods where it's tough to build something new or new at scale. So if you
Sure.
pick it up at the right basis, you're not going to be able to necessarily easily get call it a 15-story building permitted by right today. So you're easier to go that route.
Right, right. And which is all very true, but from an efficiency standpoint, you will have weird corners in strange places and, you know, bedrooms down long hallways and just all kinds of you just have funky layouts. I mean,
Yeah, we
there's just
saw it on a
inherent.
hypothetical project where about 65% of the building had rentable or saleable square footage. And that's why that project didn't work. You're leaving almost a third of the project, or a little over a third of the project, as just dead space. Maybe it would get turned into miscellaneous amenity space, but it's not going to be highly trafficked or efficient space.
I used to own a building which was an old cigar factory that got turned into residential, and because the depth was so ridiculous, the guys who did the conversion, which is before I owned it, they just built the world's widest hallways. So you had these hallways that were like you could roll industrial equipment down because I guess they just figured it wasn't valuable to put it in the apartments because no one would pay for it and it would make the apartment too weird. So the solution, and I'm putting solution in air quotes, was you had hallways where you're like, you could literally drive a truck down the hallway and you're like, okay, great. like it was just weird and out of scale. Because how big
And it
does your
doesn't
hallway
add
need to be?
value to any part. It's just how it has to be done or how they
Right.
thought the best
Right.
way to do it was.
You just throw down more carpeting and you throw in more lights, and then you just have the world's biggest hallway, and it just looks weird. Yeah, 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 yeah. No, look, this is all very good to go through, and I'm glad you brought up the office conversion stuff. So, again, for those listening, Zanzibar Capital, check them out. They are active value add and development players, and I'm glad we had a time today. Had time today, Eric, to talk. This was all very constructive.
Thank you, Josh. I had a great time with our conversation and looking forward to seeing who else you have on the show.
Thanks again.
All right. Thank you, Josh.